and welcome to Money Manager. No, it's not Lindsay Williams. I'm Nozipho Mbanjwa standing in for him today, and we're taking on a rather exciting topic. We're talking about the exceptional exceptions. Now, if you haven't heard of this term, you're about to hear about it. This is from the CIO of Cannon Asset Managers, Adrian Saville. He is in studio to help us understand how the exceptional exceptions survive during tough macroeconomic environments. Adrian, it's always lovely to have you on any show on CNBC. Now, exceptional exceptions, it sounds like a phenomenally sexy term. You've always got these great terms that you put together. Take us a couple of steps back and tell us, what does this exactly mean, and how did you come to identifying the exceptional exceptions?
I think there's two parts to the answer to put on the table in thinking about that question. The first is, when investing, many people invest in anticipation of a company delivering blue sky. And in its most extreme form, this takes the flavor of growth investing. And if you get growth investing right, you've bought into a great business that delivers fantastic earnings, and you are more than amply rewarded for that. The tragedy is that most businesses don't deliver the earnings that they promise. And this is not unique to industry or to country or to size company. In country after country, in industry after industry, and right across the company size spectrum, businesses tend to stub their toes in their attempt to deliver the growth that they promise and that investors anticipate. Some of that, and the second point then in responding is some of that toe stubbing, wow, is by their own design, or by their own mistake, that they get in their own way. But more often than not, the single biggest factor that influences disappointment in companies failing to deliver what investors anticipate is the economic environment. The economic environment explains, across the 25 countries that we've surveyed, somewhere between 2/3 and 3/4 of bottom line company performance. As Bill Clinton's election advisor put it, it's the economy stupid. The economy really matters in explaining business performance. And if we can account for the influence that economy has, we can then go in search of businesses that are able to do something that is at odds with that. I'm yet to find the case of a company that has been able to achieve complete immunity from economic gravity. But the exceptional exceptions are businesses that are able to achieve what I'd call escape velocity, that they are somehow able to pull away from this overwhelming influence of economic gravity. So
they survive the tough macroeconomic environment, in essence. They don't get off scot-free, but they do survive. What are those survivalist strategies that they are employing and that are helping them to get through this period?
Well, not only do they survive, but to add to that, they thrive. So they flourish almost regardless of the economic circumstances. And maybe we can come back to the factors in a second. I think it's just worth noting before we talk about who these companies are and what they've done, just to give some substance to this exceptional exceptions label. The work that we did in South Africa is designed around a study that Columbia Business School professor Rita McGrath did in looking at 5,000 companies listed on international markets. She surveyed businesses over a 5-year period, and to identify a business as thriving, she put up the criteria that the business had to grow their top line and their bottom line ahead of inflation and ahead of world economic growth. Inflation, because that's a nominal number, you can't eat inflation, and world economic growth, she just treated that as a very crude proxy for market share.
But the period then must have been very, very important in terms of that window of 5 years that she's chosen.
So her first 5-year period is 2005 to 2009. And she comes back with the very sobering result that of these 5,000 companies she surveys, only 10% can do uninterrupted top line and only 5% can do uninterrupted bottom line. And then she says, well, the economy matters, my earlier observation, and I bet you if I go to easier macroeconomic times that this result will improve. So she goes to the early noughties, 2000 to 2004, and she finds that the result does improve. In fact, the hit rate almost doubles. It goes to sort of 15% for top line uninterrupted and about 7 or 8% for bottom line uninterrupted. But that 15 and 8 and these are minority results.
Yeah.
She then went to a third intriguing question. She says, well, if these businesses struggle to do 5 years uninterrupted, and the second 5 years was an even smaller result than the first 5 years, I wonder if the guys that carried on in the second 5 years were the same guys that had done the first 5 years. In other words, or to put it differently, are there any businesses that have done 10 years uninterrupted top line and bottom line growth? Her result of the 5,000 companies that she surveys, 10 businesses.
10 of the 5,000. So, and these are the exceptional exceptions.
And these are the global stories. And they're big businesses. Their market caps are $1 billion. And the exceptional exceptions are, they're unusual suspects. There's no Coca-Cola, Google, BMW, Apple. Instead, the exceptional exceptions are the Spanish construction firm ACS. Not Google, but Yahoo, and not Yahoo generically, but Yahoo Japan. Atmos Energy, a 100-year-old alternative energy business in the United States. FactSet, which sells financial services to you and me. And there is nothing in common in terms of these businesses' size, age, management culture, industry, diversification. It looks like it's just this eclectic, almost random gathering.
Mix of companies.
So on the back of her research, we repeated the research in South Africa. I had 2 reservations with her results. The first was that she only had 1 start year. So, what if there was something funny in that start year?
Yeah.
So we used 7 different 10-year rolling periods. 7 different start years, in other words. And the second was that over her survey period, almost all South African companies had market caps below $1 billion. So she overwhelmingly ignored South Africa in her research. So we lifted the cap off company size and we went all the way down to the smallest listed businesses. And over the 7 different rolling 10-year periods, we find the businesses that have achieved the same result, that has produced uninterrupted top line and bottom line growth. And the result
mix
is
as eclectic as her findings?
It's as, when you look at this, I was like, what on earth do these businesses have in common? Because the superstar businesses, these exceptional exceptions, are Clientele Life, EOH, Famous Brands, Mr. Price, Wilson Bailey, Truworths. In highly competed, cyclical, vulnerable, sensitive industries where you would imagine that a clothing retailer, a fashion retailer, a fast foods business,
construction company,
insurance firm, these are the businesses that you would describe almost as being the most vulnerable. Instead, they are the most resilient.
So what is it? What is the magic? What is it that they've done differently?
Rita McGrath finds in her, she calls them the outliers. In her study of the outliers, she finds they have 2 overwhelming attributes that are consistent across all of these businesses. The first is they have agility. And agility isn't speed. Agility is the ability to choose your speed. Meaning there is a time to go fast, a time to go slow, a time to expand, a time to contract. But agility also is demonstrated in speed in that you leave yourself optionality. And the optionality comes in the form of taking lots of small bets. And when you see a bet that works, you're able to seize that opportunity. A great example is Clientele. So of these different businesses, there are only 2 JSE listed companies that have produced 15-year uninterrupted earnings growth, top line and bottom line, after inflation and after economic adjustment. And that's EOH and Clientele, off most investors' radar. And Clientele is a great example of this agility. They go to Nigeria. They spend 15 million rand on their insurance endeavor in Nigeria, and they find that they can sell insurance, but they can't collect the premiums. You only make money in insurance when you collect the premiums. The sailor is a loss leader. So they come back from Nigeria, and I don't want to say with their tail between their legs, but with the experience that they're not going to make money there in the then environment, and they write off their Nigerian investment, 15 million rand, 15 million. Their market cap is a couple of billion. Telkom goes to Nigeria, and they buy Multilinks, and they write off 10 billion with a 20 billion market cap.
Significant
which
picture.
business is likely to survive and which business is likely to find opportunity, by being giving themselves lots and lots of different bets. And so the agile businesses, take lots of bets, and then they only fire the cannonballs after they see that the bullet has hit the target.
So now I want us to get into your forecasting for South Africa. I see in the report you're rather optimistic. You see growth potentially going to 3.5%, if I've seen that figure correctly. And having had this conversation, the exceptional exceptions would do exceedingly well in a 3.5% growth environment, because we're currently sitting around 2 and maybe even hovering to dip beyond that.
Sure. So just very quickly, a second attribute that these businesses have is they have absorption alongside the agility. And absorption riles investment managers and accountants, because it comes in the form of fat, lazy balance sheets, as an example. In the interest of time, I won't elaborate more on absorption, but absorption is not just the ability to withstand pain, it's also the ability to seize an opportunity when you see it. What kills many businesses isn't lack of growth, it's growth that they can't digest. So absorption is not just about taking punches, it's also being able to step into the arena and throw some punches. Our forecast for the South African economy is that structural growth sits around 2.5% to 3%, not the 5.4% that the NDP says, tragically, but somewhere in the 2 to 3% range. And as 2015 stands, I would say that we are closer to the 2% than to the 3% lay of the land, given the energy deficit, a sluggish Europe, a sagging China, and so on. The agile absorbers are businesses that have both of these attributes, and they can harness them effectively to navigate this environment. Now, having demonstrated your capability as an agile absorber doesn't mean you've got it forever. So there are businesses which have historically demonstrated these attributes, but then have lost them. A company like Tesco in the UK would be a good example. It used to have fantastic agility. It's lost it.
Now, very quickly, Adrian, just before I let you go, we've run out of time. Exceptional exceptions, wannabes, the ones that could make it into this portfolio. Maybe your top 3.
So a couple of great ideas. One, Logics, the logistics business, I think is a really interesting idea. A long way off many investors' radar in this current environment is the building and construction firm Wilson Bailey, which has stubbed its toe in the last couple of years. I think that they will fight their way back. I would put those two into an equation that gives you a great result over a couple of years.
The exceptional exceptions, that's Adrian Saville. He is the CIO of Cannon Asset Managers, giving us his insight into that rather sexy term, but no doubt survivalist stocks that we've seen in the last 15 years. Thank you so much for making the time to join us.